is your weekly rate update, and rates have improved a little bit since last week. Let's talk about the biggest story, which is crude oil. It is back to pre-war levels before we entered the Iran conflict. It fell to $72 a barrel on Friday, the lowest since we entered the conflict. And as shipping transits through the Strait of Hormuz accelerated, with volume surging as vessels openly navigated the waterway and the Persian Gulf exports recovered to roughly 75% of pre-war levels. Saudi Arabia began loading tankers at its Ras Tanura terminal, signaling a major regional output ramp up. The WTI settled below $70 on Friday for the first time the day before the Iran war began. So that is great news there. But then over the weekend, a little bit of an escalation and then a halt. Iran struck a supertanker carrying 2 million barrels of oil over the weekend, prompting the U.S. to retaliate with airstrikes. But then both sides agreed to halt the attacks ahead of peace talks in Doha on Tuesday. So we'll see how that goes. And then also the PCE hit 4.1%, but analysts are saying this is the peak. The PCE price index rose at an annual rate of 4.1% in May, the highest level since April of 2023. But the drop in crude oil prices in June isn't yet reflected in this data. Analysts expect that inflation will start going lower now that the Hormuz has partially reopened. So sounds like some good news coming down the line there. And also, by the way, PCE, I refer to it all the time. It stands for Personal Consumption Expenditures. It's the Fed's absolute favorite measure of inflation, so that's why tracking this is super important. Also CPE, which you'll hear me say a lot, means Consumer Price Index. That tracks a fixed basket of goods, and the PCE is just broader. It tracks what Americans actually spend money on and adjusts for spending habits that do change. So, like for example, if people switch from beef to chicken because beef got expensive, then PCE actually captures that shift. The CPI does not. So that is why that's the Fed's favorite measure of inflation. Now, the Fed's target is 2% PCE inflation. Right now, we're at 4.1%, which is more than double, obviously, right? And this is why rate cuts are off the table, and they're even discussing a potential hike. We will see, but I would not expect rates to come down. Here's the bottom line, summary of it all. The June CPI on July 14th is now the single most important data release of the summer. It will be the first print that captures the oil price decline. And then the July Fed meeting, which is July 28th through 29th, is basically them considering a hike versus keeping rates where they're at. So your borrowers need to understand this risk before letting rates float and waiting for rates to go down, right? Anyone sitting on the fence waiting for rates to go below 6% should now understand that even if the CPI improves, the Fed's very hawkish, which means the path down is slow, so we're likely not going to see any large rate improvements this year. Hope this is helpful. Hope you have a great week, and we'll see you at the next one.